Investors, have you ever seen a tech company that grew its top line exponentially in a short period of time, yet remained completely silent when it came to profit margins and cash flow? That company is Datasea. Listed on the Nasdaq, Datasea conducts most of its business operations in mainland China and has rapidly expanded its business around smart messaging platforms and intelligent acoustic technologies. As recently as 2022, this company generated annual revenue of only $3 million. But within just a couple of years, Datasea reported approximately $71 million in revenue for 2025, redefining its market presence. But the real questions begin right after that. Despite this explosive top-line growth, the company posted a gross profit of only around $2.5 million. This equates to a gross margin of just over 3%, which is highly unusual given that most platform-based tech companies maintain average gross margins of 50% or more, some even above 80%. So what kind of business model yields such low profitability? From an investor's standpoint, we start uncovering a key mystery: the disconnect between revenue and earnings. The first plausible scenario is that the company might have signed extremely low margin contracts in order to quickly acquire clients. This type of strategy, while not uncommon during early growth phases, can significantly undermine mid to long-term profitability and cash flow. The second possible explanation concerns the company's revenue recognition method. Some companies recognize the full value of a contract as revenue upfront, even though services are delivered over an extended period and cash inflows are staggered or deferred. This creates a considerable gap between reported earnings and actual cash received. This structural mismatch moves beyond theory and begins to materialize through a series of real-world events starting in 2024. In January 2024, Datasea received a non-compliance notice from Nasdaq for failing to meet the minimum bid price requirement. In response, the company executed a reverse stock split at a ratio of 1-for-15. Investors should note that reverse splits are typically used by companies in distress to maintain their listing status, not by firms with clear, strong fundamentals. Just months later in May, the company received another notice, this time for failing to meet the minimum stockholders' equity requirement, signaling severe deterioration in its capital structure. Finally, in July of the same year, Datasea raised new funds through a registered direct offering. Unlike public offerings, this method involves issuing discounted shares to select institutional investors, leading to more significant dilution risks for existing shareholders. So what do these events collectively suggest? They hint at a potentially fragile internal cash flow system, one that